Hey everyone, welcome in to another daily editorial here on the KE Report. We are chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, another day in the markets where we seem to be heading a little bit higher. Now, the U.S. equity markets have kind of turned around today as they started off first couple hours of trading moving higher. The last hour of trading has moved a bit lower, so we're actually seeing the S&P in negative territory today. The US dollar is continuing to move lower. It is now below 110 on the US dollar index. Focusing our attention on the precious metals, gold is up about $13, silver about 15 cents. The important thing, though, I think, is maybe more the stocks. GDX is up almost 3%. GDXJ pretty much up 3%. SIL up about 3.25%. As we were chatting off mic, Jordan, you said that you think a major bottom could be in for the precious metals stocks in particular. Take us through why you think that, please.
Okay, well, it's a combination of technicals and macro. And looking at the technicals, in the last month or two, we were talking about positive divergences. And I think we saw more of those last week, where even in the middle of last week, you had gold making a lower low compared to the previous week, yet the rest of the sector did not trade at a lower low. Then on Friday, you had gold intraday made a new low by $1. Of course, that was reversed, so you won't see that on any closing charts, but it made a new low by $1 intraday. And if you look at silver, not even close to making a new low. The stock's not even close to making a new low. At the same time, remember, silver's low actually was the first day of September. Now, since that point, and at that point, gold was trading at about 1,700. So gold still had this decline below 1675, trading down to 1621 last Friday. Silver, the entire time that happened to gold, did not make a lower low. And if we look, I mean, I don't have the ratio charts in front of me, but if someone pulled up a chart of, GDX versus gold or GDXJ versus gold, they would see that the miners have been leading or at least outperforming gold. At the same time, they've also been outperforming the stock market for a little while. We also talked about the GDX advanced decline line giving a third bullish signal in the last 7 years. So when you look at all these factors, and then if you just look at pure price action, you look at the miners and what they're doing, they're kind of building potential inverse head and shoulder bottoms. Now, they have not broken out yet, but if you look at things like, if you look at the silver stocks like SIL and SILJ, they're really similar, but those are trading pretty close to initial resistance. GDX, GDXJ, and the Huey are not quite there yet, but you can draw potential necklines on these charts just from recent highs in, I think, early September, and then at the very beginning of October. You kind of have necklines there. And so potentially, if GDX and GDXJ broke above these necklines, there would be measured upside targets near the 200-day moving averages. And so, for example, for GDXJ, it's trading below 31 right now. The 200-day is, I want to say it's in the mid 37s. And GDXJ actually made a low already really close to 26. And so today, I think it might have hit 31 or close to it at the high. So that's already a decent move, from that potential low at the end of September. So technically, you can make a good argument that at least over the short to medium term, there's a lot more upside here. I mean, you noted the weakness in the dollar. I don't know if we've hit the top in the dollar. I think it's still possible next year. The dollar could make another move higher, and it remains to be seen how that would impact things. But I think at least short to medium term, you could see more downside in the dollar, even if it's a corrective move. That's going to give more juice to precious metals. So we're starting to see that. And on the macro side, and I've been talking about this for the last couple of weeks, it's really a question of how much more is the Fed really going to tighten? Because we're only a week or two away from that November meeting. So after that, they'll be at 4%. Maybe they want to see if they can get to 5%, but it's very, very unlikely we're going to see a Fed funds rate at 5.5 or 6%. Especially now, I mean, in the last 24 hours and today, we see that the 3-month to the 10-year yield curve. That's another one, and that's the one that the Fed is really concerned about. It's really like a final recession warning, where the 2-year and the 10-year is kind of the initial warning that everybody looks at. So this yield curve has finally inverted. And if you look at other things like, Bloomberg, all of their indicators, they reported that there's now 100% probability of a recession in the next 12 months. So look, that doesn't mean the Fed's not going to hike to 5% or 4.75 or whatever, but in a week or two, they're already going to be at 4%. And as we know, the market, it looks ahead, it discounts the future, it anticipates things. And if we're looking ahead to next year, the macro situation could be you have a recession and the Fed is going to have to ease policy at some point. Obviously they're not going to, cut rates immediately if they don't have to, but if you're looking out over the next 6 to 12 months, it's pretty reasonable to think that, they're probably going to cut rates, maybe from, I don't know, 5% down to 2.5 or 4.5 down to 2.5, something like that. I mean, it depends on the severity of the recession and corporate profits and job losses and all those things. But if we're just looking at that macro setup for next year, I mean, that looks to be a really reasonable expectation. And we're looking at the technicals here, specifically in the stocks. I mean, I'm a little bit less comfortable when we're looking at gold and silver as a whole. I mean, they would need to break more resistance, but obviously silver's been leading gold, so that's a good thing. But when we're looking at all these things together, I think the short to medium term should be really positive here for precious metals. And so you have to, and then when you look at the macro situation, as I just explained, the bearish case would be, well, the Fed is tightening, they're going to continue to tighten, they're going to tighten to 5.5% or whatever. They're already going to be at 4% in a week or so. So and the market looks ahead. So the market knows that they're going to be done at some point here in the next month or couple months. And then at that point, I really don't see what the bearish case is for precious metals. I mean, real interest rates are, they've been zooming higher, but they're going to peak when the Fed stops hiking. So if we look at all these things, they're really set up for the market to have a really good move. And only in time will we be able to say, yeah, that's a major bottom. But I think looking at all these things and looking at the high likelihood, continued strength here in the short term, I think we definitely have to think about, the potential for a major bottom being in.
Well, Jordan, that's an encouraging thought. And like you mentioned, there's a lot of non-confirmation signals with silver having bottomed first and moving higher, with the stocks and the GDXJ and SILJ not really breaking down when gold made a lower low, and all the macro factors you just outlined that are setting things up. So I guess just to restate or ask you about this, for a while, all we heard for months was that if 1675 broke that level, that we could set up a waterfall decline down into the 1500s. People came out with targets in the mid 1400s down to the pandemic crash low. Some people got down as low as 1375, saying we retrace all the way back down to that key level that was key resistance and then became key support. Is that all off the table then if we break above these necklines in the stocks, and if silver keeps clawing its way back up? Then at what level would you feel comfortable kind of giving an all clear that, yep, it was the major bottom?
That's a really good question. I have not. Well, with precious metals, you can never say never. So looking at gold, gold has resistance at 1725, kind of around that area. If gold is able to rally above that, it's probably going to be able to reach the 200-day, which is just below 1800. So I think that's the first major resistance. 1800, then especially 1900 is going to be major resistance. But it's fun to think about this, but I don't know if the answer really does anyone any good, because if you're waiting for gold to break 1800 or 1900 to buy, I mean, how much are the stocks going to be up at that point? So I just think that the better answer is, short to medium term, there's going to be a rally. And yeah, I would lean towards, a major bottom being in, especially if gold can, run above 1725 there and at least test the 200-day. That would be my answer, because I don't, looking out beyond that. And again, this is where, I'm a technical analyst, but this is the problem with a lot of technicians and chartists. is they only look at the chart and that's it. They don't look at anything else. I mean, they don't look at sentiment. They don't look at the macro fundamentals. And with those things, I mean, you have to look at those things when you're also analyzing charts. So that's why it really depends on the macro situation. If a severe recession or a real recession is coming next year, the Fed's going to have to ease policy, and we're going to see gold's going to rally and probably at least next year, retest the all-time high. If that happens, then I would say, I'm not concerned about any particular level. Now, if we only kind of have a mild recession or it looks like a soft landing, you could still see gold rally to 1900 or 2000 because in every soft landing, the Fed always eases policy. So they're going to have to ease at some point. But in that situation, you just get a rally in gold for, 6 or 8 months or 4 or 5 months like we've seen in the last 6 years. And then you're not in a real bull market yet. So I think we have to think about those types of scenarios. I mean, and then I guess you could say there's some deflationary scenario, but I really don't see that coming. I mean, a deflationary scenario where gold's going to go to 1,300. I mean, what is that, like a 20% decline? So in that scenario, you'd have the S&P dropping another 40%. I mean, I just don't see policymakers letting that happen. I mean, the dollar breaking above 120 and having this big run next year, that type of scenario, the Fed will be easing in that scenario. I mean, because the dollar is going to be wrecking everything significantly. And so the Fed would have to ease policy in some way. So, I mean, it could be, we did see something like that in 2019 where the dollar was going up and the Fed had to ease and, gold went up and broke out from that resistance anyway. So I'm just giving the full color to your question. Why it's at this point it's kind of ridiculous to say, well, if it breaks above this level, major bottom is in, it's going to break out and go to 3,000, because it really depends on the macro developments that come next year. And so that, to me, I'm more comfortable with thinking about those than gold breaking above a particular level. I mean, the real answer would be like 1,900 on a monthly basis. That's really the correct answer, but we're in the 1600s now. So, I mean, that takes way too long if you're waiting for that to happen before you get in the market. And then, initially you have initial resistance in the low 1800s, around 1800. So I don't mean to give this long explanation and kind of avoid giving an answer, but that's the reality, is that you can't just give a tiny answer. Well, yeah, if it breaks, 1725, then the bottom is in and, everything's going to be great, because it depends on all these other factors that we can't really predict right now.
And it seems like so much is just hinging on what happens next year with the economy, with central bank policy. Jordan, are there any stocks within the mining or gold sector that you are using as a barometer to show you if sentiment is improving, if investors are coming into the sector? Because I look at some of the big boys, Yamana's done okay, Kinross been okay. Newmont, though, that still is generally struggling, trading at a much lower range.
Yeah, I mean, I'm not looking at any particular stocks individually as indicators. I mean, looking at Newmont had this really nasty decline from 85 down to 40. If you look at the last 4 months or so, it's been trying to build a bottom here. I think it has been building a bottom. And, if we do get this rally, Newmont probably has a chance to break above 44 or 45. But, yeah, I'm not looking at any individual stock here. I mean, for me, it's, again, I don't want to go back to looking at fundamentals, but to me, it's all about the fundamentals, because we have to think about the big money and what's going to make them buy gold. If you have a soft landing in the economy and, yeah, the Fed will have to cut rates, you're going to get money moving into the gold market, but you're not going to go into a real new secular bull market in gold. It'll be like we've seen the last 5 or 6 years, because in that scenario, the big money is going to go back into the stock market and stocks. However, if we're going into a real recession, that's not like a slight or tiny recession, and it's a real significant recession, we know that inflation eventually is going to come down significantly, because that always happens in a recession. And we know that the Fed is going to have to ease policy, even if inflation comes down to 3 or 4%. If you're in a significant recession, the Fed will have to ease policy. If it's significant, you'll see fiscal stimulus. I mean, the government's probably going to be divided in some way. So you need a significant recession to get fiscal stimulus. But I mean, in that scenario where it's a significant recession, you are going to see a lot. You are going to see Fed easing, and you are going to see significant money move into gold. And so that to me, those are the most important factors to look at, especially when, you've been in kind of a cyclical bear market here, and gold hasn't been in a real secular bull market yet. And that's why I'm so key on these macro fundamentals, because I mean, you could look at charts and say gold breaks a certain level and yeah, that's great. And, monthly close over this level. But if the macro fundamentals are not lining up with that technical action, then gold is going to at some point just sputter out and capital is going to flow elsewhere, like what has happened over the last 6 years. So I don't mean to keep repeating myself and saying it's the fundamentals for every answer, but that's what I would be watching closely is, these economic indicators and all of those things, because as soon as the market thinks a recession is coming, for sure, you're going to see long-term yields come down, and the Fed is going to soften its tone and eventually move to easing policy. And in that scenario, that's when money is really going to flow into gold. And I don't know. I mean, we could be seeing the very, very start of that in the last week or two.
All right, Jordan, we'll wrap it up here. Sounds like it's all about the macro fundamentals here, watching what the Fed's going to do, watching where data goes. We'll see how this all plays out, but it is encouraging at least to be going through another bounce in these markets, and even some of the charts, especially GDX, GDXJ, putting in higher low from the most recent one. Hopefully that truly is the bottom, as you have outlined. Thanks again for your time, Jordan. We'll chat next week. Have a great rest of your week.